welcome everybody to another Pepperstone Learn It Live webinar. My name is Thomas Atkinson. As always, I'm joined by Tyrone Abella, but tonight we're going to be covering off trading trends, the secrets the big banks don't want you to know. So quite a few interesting things tonight. We're both obviously from FX Evolution, and Tyrone, what do you think about the last 2 weeks since we were last here in terms of trading? It's been pretty interesting.
Yeah, definitely. We're starting to get some good setups playing out properly now, which is good. The technicals are starting to really take shape. The market correlations are starting to kick in as well, which is really good. We might touch on those tonight if we get a chance. But yeah, look, the markets are looking good for trading. Anyone scalping or even the medium term sort of outlooks are really, really good. So there's plenty of good action in the markets at the moment. So I think we're going to see some very positive moves in the next few weeks.
Okay, well, let's get started with the risk warning. The information provided in these videos or webinars tonight has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification, and of course is only general in nature. And you should always seek your own independent financial advice before making any investment decisions. So a few things we're going to be covering today or tonight for some people, and that is how to correctly identify trends using some simple moving average methods. We're going to look at recognizing areas where to take profits and stop losses and how they should be placed, one that many people do fail at. And we'll be talking about how, I guess, the big banks or the bigger traders take advantage of many things that people do. Going to be taking a look at what market conditions to look for before placing a trade, and of course a few tips and tricks later on to help better analyze the charts, and then followed up by our Q&A session. So remember everybody, if you have any questions during this webinar, please feel free to put them in the room and we will try to get as many of those done by the end so that you can ask some really good questions, and we know that everyone learns from that, so we love those kind of Q&A sessions. So before we get into some of, I guess, the tips, let's just talk about what trend trading is. And we do this quite often in our webinars. We talk about that trend traders generally hold positions for a few days to potentially weeks. Now, that's the traditional method. That's what most people do. Obviously, there's swing trading as well, which might be on a little bit shorter time frame. But if you want to trade the daily 4-hour charts, typically speaking, you will usually hold positions for a few days. Some people like to close over the weekends, but that's generally what I'd see. Well, I mean, you agree with that, yeah, Ty? I think trend trading in Forex terms about that time.
Yeah, definitely. You're going to get the results in a reasonable manner, and the best thing about that is you're going to know whether you're in the correct direction fairly quickly too. So, and that's pretty important because time in the market is time at risk. It's really, really important to remember that. A lot of times, people forget that they're quite happy to sit in the markets, for days and days on end and hoping it goes in your right direction. But the longer you're in the market, the longer you're exposed to adverse movements in the market. So you want to limit your time potentially by picking the right time frame for the trade that you're looking for, and that definitely fits that bill.
Often we get asked the question, what type of trade can I do if I live a busy life or work, let's say 5 days a week or 4 days a week at least? And that would probably be trend trading. There's a saying out there that says trend is your friend, and it couldn't be more true. It helps you get your take profits hit, and it also helps go in the right direction. If you were flipping a coin and always following trend, then generally speaking, you'll be way more successful than trying to counter. And we all love a good counter trend. I know we've been there, everyone's been there. It's something that unfortunately often hurts traders when they first begin. So another thing we like to do at FX Evolution is we like to talk about the top-down approach. Now, this is an approach where we start at the highest time frame we want to be looking at, and then we work down through the time frames, that multi-time frame approach. The banks know, and many of the big traders out there know, that when somebody starts trading, oftentimes they'll only stay on one chart time frame. It might be the 5-minute, 15-minute. We usually see people start there, maybe up to 1 hour. But you won't often do multi-time frame analysis where you'll go through multiple time frames, see how the technical analysis or fundamental analysis kind of looks in terms of the charts, and then make your decisions. Often you stick to that one time frame. So that's really a big mistake. You want to be starting to look at multi-time frame analysis. You then need to be able to recognize trending or range-bound markets. A simple trick in terms of recognizing a range-bound market is to learn how to spot a channel pattern. Once you have spotted a channel pattern and you have rules around that, that's always a very good indicator that the market has come out of trend and it is now range bound, and you can begin your range bound potentially trading strategy. So a trending market will have, of course, higher highs, higher lows, that kind of thing, or lower lows, lower highs, whereas a range bound market will generally create a channel pattern. And of course, we also want to use lines, bars, and candle charts. Another thing that a lot of people fall into the trap of doing is just using candle charts. We all love candle charts. There's many reasons to use them, but also consider line charts. Remember back when trading first really began in terms of people plotting everything, they plotted it on a line. And we can tell you that when you're drawing top end support resistance, using a line chart or the close price is incredibly significant, and it is used very, very heavily with the bigger banks and bigger traders out there. I mean, Tyrone, do you want to point out, what do you think about line charts? It's often underutilized.
Oh, most definitely. And you really appreciate what a line chart does for you when you actually start carrying out your analysis on it in the rawest form. So when you start drawing your trend lines, your patterns, because it really does take away a lot of the noise that can otherwise confuse, especially traders who are first starting out, who can't really see between the noise and what's actually happening in the market. The line chart just takes away all that ambiguity away, and quite often it really clears up patterns that you wouldn't see if you're only using a candle or a bar chart, because there's so much noise around it. Like when you run an experienced eye over it, most of the time you will analyze and see that pattern. But as even us, look, we've been doing this for more than 10 years now, and we at least a couple of times a day go back to a line chart just to make sure that we haven't actually missed anything, because it's really all about ticking every box and making sure that you're covering every base when you are doing your analysis. And the fact that it uses the close price really smooths out what the price is doing. So it is very, very important for beginning traders and experienced traders alike.
So we'll actually be doing an analysis in the charts tonight of a top-down approach, and that will hopefully help clarify some of this to some of the newer traders out there. But another thing we want to do is we also want to stick to maybe the major currencies. Now, the reason why I think this is kind of a tip against maybe the bigger the banks, the way the banks kind of trade out there, is that they also do and are very aware that maybe the side or more exotic currencies don't trade as much technically. So if you're a technical trader, you probably want to stick a little bit more to the major currencies, and that's just because there's more volume there, there's more technical trading there, there's more algorithms there. So I would say a top tip, stick to the majors when you first start, and then start to expand your horizons and expand your pairs as you move forward from that point.
Yeah, that is a really important point, because the thing is, what a lot of beginning traders do is they try to look at too many things straight up. But if you do master those majors, right from the onset of your trading, or even if you've been trading for a little while, if you really understand what the Euro USD and the Pound USD and the USD Yen are doing, that really gives you a lot of confidence when you actually go to the cross pairs, because you've got to remember the cross pairs are being basically formed on the basis of what the majors are doing anyway. So it really is important to understand exactly what all of the majors are doing before you trade any of the cross pairs anyway, to give you a bias of what one country is doing against another. So even for us, like, we spend a lot of time looking at the majors before we even go to the cross pairs, and we'd never trade a cross pair without actually verifying what we're seeing on some of the major pairs to make sure that actually everything is in line with what we're looking for. So don't be afraid to just to 4 or 5 at the start and really try to master them. Like, you've got to remember, with 4 or 5 pairs, you've got probably at least 3 or 4 different timeframes you can trade in that. So straight up, you're looking at about 20 charts. So there's plenty of time to get through and trade. You don't have to have 100 charts open on your screen.
So another thing that we mentioned or we pointed out was multiple time frame analysis. So for anyone out there, what kind of candle are we seeing on the right hand side? What kind of candle pattern are we seeing? I'll let everyone answer that. But you can see here on the 15-minute candle, we see a bit of a different story to what the 4-hour may look like. We see, of course, some buying during that 4-hour candle. where we've got each one of these 15-minute candles shows buying, and then of course it hits a high and suddenly starts seeing some bearish action and some selling coming through. Now, if we were looking at the 15-minute candle time frame, this is what we see. However, and many people are absolutely correct in their analysis here, on the 4-hour candle, on the close on that candle, we see a shooting star, which is a very bearish type of candle pattern. So yes, on the 15-minute, we see one style or something happening here where we've had bullish and bearish movement, but this 4-hour close is so significant. And if this is at a key point of resistance as well on the 4-hour time frame, our chance of success with this trade is very, very high. So remember, guys, if you're ever trading a certain time frame, like an hour or 15-minute, always just go up through those time frames and check out the closes on those candles. It's something that I just don't see enough people do when they first begin, or even more advanced. They just don't do it. And Tyron, how significant is that candle? I mean, if I saw that and I was already in a trade on the 15-minute towards the short side, you could potentially be leaving your trade in for a little bit more, couldn't you?
There's only one more candle that's more deadly than this candle for a bearish candle, and that's a gravestone doji, and that's not much different to this one anyway. So, you know, and the reason why this is important, like you might say to yourself, well, why would it matter if you were trading a 15-minute chart? Okay, so the important, I'll explain that. If you look at the 15-minute candles in isolation here, and you didn't have the 4-hour candle showing what is effectively one of the biggest bearish candles there is, you could be fooled into thinking that maybe even after that last dead candle, the big red candle that broke down prior or even further down than the open, you might think that there might be a little bit of a bounce back here, or you might think price is actually finding a little bit of a base. So let's just say you might have a little bit of divergence on one of the indicators. So you might actually be inclined, even though the last 8 or 9 odd candles have been very, very weak, you might be inclined to think that it might find support here because it opened relatively close to where it is now, and a bit of divergence might tell you that it might bounce from here and start heading up. You would only think that if you weren't looking at the 4-hour candle, because to me, you look at that 4-hour candle showing the same price action, there is no way on God's earth I'd be taking this long in the shorter term. There's absolutely no way. But if you didn't see this candle, you could easily be fooled into thinking that it might have found a base around where it opens. So even though it's gone a little bit lower, you might think, well, price might retract a little bit more and we'll be off and running to the long again. This is by no means a long candle on a 4-hour chart. So that's why it's really, really important to take a look at the bigger time frames around the patterns that you're seeing, just to give you the heads up on what other people are seeing. Because you've got to remember, the more people that are seeing something, the more people that are going to trade in that direction. And all the big money is looking at a 4-hour chart and a daily chart. They're not always necessarily just looking at a 15-minute.
So another thing you want to do that I guess is a bit of a tip before we get into a few other kind of things that we believe are really good about candles is that you want to probably begin or most of the time trade in currency trading 1 hour, 4 hour and daily charts. We generally find that people have quite a lot of success on these time frames. It allows a lot of logical kind of decision making inside the market. It also allows you generally to have a stop loss that's big enough to maybe wear some of the middle news or even some of the basic red news that you might see in your economic calendars. And we really feel that this is a great place to follow trends. Generally, you should be able to find at least 3 to 5 good opportunities per week with a selection of around 10 to 20 pairs. And you can always consider back testing a strategy using MetaTrader 4, 5, or of course CTrader. So that might also help you when you're checking out the 4-hour daily. It can be quite difficult to back test 1 minute, 5-minute charts because you may not have enough data. And we find that these timeframes really do give quite a lot of opportunities. You also, as we always mention, want to spend time learning the way the market moves. Each currency will move slightly differently during the times of days and how the currency reacts to different news events. Remember, the big guys out there know how these currencies react. They're very knowledgeable in those areas. A lot of people don't know, but when it comes to, let's say, big traders out there, oftentimes when they're only employed to look at a few select kind of pairs or a few select things and become experts at that. They often aren't all encompassing around all investments in the world. They hone in on an area and they become very good. I mean, Ty, we know people out there that literally just focus on, let's say, just indexes and futures trading indexes, and that's all they do.
Definitely,
So
definitely. Yeah, and it's important for, look, a lot of people are probably saying, well, why would you need to be an expert in one particular pair or, yeah, one particular sector? And the thing is, when you get, it's almost like a relationship with that particular pair. You understand what its ranges are, and that's probably the most important thing. Like, say, to give you an example, like if you are really a big watcher of, say, the Euro USD and maybe the Pound USD, say, yeah, those two pairs were your big watch, you would have a very good idea as to what an average move for them is each day. So, for instance, it might be a 70 or 80 pip move either way. So it might swing, 70 to 80 pips up or down. That's an average move. So straight away, you know that the market is behaving, or that pair is behaving in a manner that you would expect. Now, if you jumped on one day and it's gone up 170 pips in a day, you know that there's actually something very different to what's happening in the market. Because you know that normally that's twice as much that would normally move in the space of time that you're looking at. So that could really, change the way you're about to place a trade, because you're aware that it's doing something that is not normal. And that's really, really important. That's why having a relationship with what you're trading and having a good understanding of what it does is really important, because it makes you identify when something is actually out of the ordinary. And sometimes that means you just stay out of the market.
So here's another tip that we've kind of been working on and we've used over a long period of time, and that is to break candles down to percentages. And this is something we do teach in our courses and we do talk about it quite extensively. But basically speaking, most people use like fixed pip stop losses, or they might have, let's say, if we were trading a shooting star over here on the right hand side, what they might do is they might say, place the stop loss 1 or 2 pips above the high. Now, the problem with that is the big banks really know about this kind of strategy. All right, it's not rocket scientist to be able to see a shooting star and to be able to say, well, if I place my trade just above here, then I should have a simple, great stop loss. The big thing, what happens? The market during the next candle goes like this, and then all the way down, and then of course closes like this. And we've all had this. Makes us quite upset, obviously, not very, very happy. And that is what we don't want to happen to our trade. So what we like to do is we like to break down the candle to more of a percentage based approach. Let's say this was 100 pips in range, and we would basically say, okay, well, maybe we want to place the stop loss 15% behind. So if we want to place it 15% behind a 100 pip shooting star, then of course 15 pips back would be where we'd be looking at, and that gives us a market adaptive stop. Very, very important to have market adaptive kind of trading when it comes to technical analysis, and it goes for patterns as well. If you're trading a pattern, let's say a channel pattern, the channel range is going to be your take profit. In that case, it's going to be market adaptive, because how big is the range? The range depends on what the market made that channel range be, if everybody's understanding me. So incredibly important to break things down to percentages whenever you can. What do you think about this one, Tyron? I mean, I think it's a game changer.
Oh, most definitely. It's it's one of those things that makes so much sense when you think about it, and that's what trading really is. Like when the fundamental breakdown of technical analysis, if you like, is the fact that logic and common sense wins the day. So when you break things down to a logical manner, like ranges and movements of a certain channel or a certain extension, it makes sense that logic will win the day in the end, because most of the time the markets are behaving themselves. Yes, sometimes you're going to get periods of time where everything's erratic, the volatility is out of control, and nothing seems to be working. But for the most part, technicals do stand up. And look, we've got a really good example on the screen now of how simple this channel was. I mean, I know we highlighted this a few weeks ago, and it's just played out absolutely to the pip. And this happens time and time again.
So here we have, there's quite a few different things that are going on, but basically, I think I'll show everyone the pound yen, just because that was one that happened in terms of a break of a descending triangle here. but how when this type of thing happens, let's say we weren't looking at the pound yen on the daily, and this break had occurred and it confirmed broken, and then we decided that we were going to buy this market on the 15-minute time frame. Now, there may be reasons why we wouldn't to buy it on the 15-minute time frame, but our point is that if you haven't done the analysis and you haven't gone and had a look at the daily, maybe the weekly, maybe the 4-hour, if you don't do that analysis, you won't know what the bigger patterns are doing. And if you were buying on the 15-minute time frame or 1-hour time frame against this break of the descending triangle, you would be getting quite severely punished. So you do not want that.
Oh, yeah. And what happens too with a lot of beginning traders, you'll find, and I'm not sure if anyone here is guilty of this, but like we've trained, literally thousands of students now, and a lot of them make the same mistake. They'll revenge trade till their account breaks down. And if you're revenge trading this one on a breakdown of that trend line, wow. So you've really got to be conscious of what's happening around you, because sometimes they just don't come back in a hurry. And if you didn't have the daily open and you were trading 15-minute, Thomas is exactly right. Very similar to the example we had before. You just would not know that it's an absolute death zone.
They often look completely different. So if you are a person that sticks on one chart or maybe only looks at 2 time frames, you really need to start looking at more. It's just a top tip that right. We know the banks definitely take advantage
Definitely, yeah. Because the thing is too, a lot of new traders are very focused on smaller time frames as well. And look, you may well have on a 15-minute chart, even as that candle is breaking that line at the 143.90, you may well have divergence and all sorts of things telling you it's going to go long on a smaller time frame chart. But the longer trend and the longer moves are going to win the day. So that's why it's really, really important. And even, I mean, by the time it broke, you already had a 20-50 moving average cross here, as you can see, and price was well and truly underneath the 200. There is just no way you would be taking this long if you could see this pattern on the daily. But you'd be amazed at how many people would have on a 15-minute and even like a 30-minute chart.
So that brings us on to, I guess, the next point. When following trends, you really want to keep it pretty simple. Obviously, some people out there have indicators that might be something called like a super trend indicator or something like that. And realistically, all they are is a huge bunch of indicators put together, if not just a huge bunch of moving averages put together. Here at FX Evolution, we really like to use the 20, the 50, and the 200 to really define trends. So when that happens with patterns, or you're seeing a trend break or something like that, when you see these things here, and you see the cross, as Tyron mentioned, the cross happens just before the break. And that's actually incredibly significant. It also breaks below the 200 moving average, again, very significant. This happens all on the daily time frame. So you'll see us time and time again use the 20, the 50, and the 200, very important moving averages to put on your charts. And even here on this New Zealand CAD, you can see it's come back and it's testing this zone, testing this point of role reversal, which we'll talk about a little bit further on in this webinar. And at the same time that that's happening, you can see that this 20 is trying to get above the 50. So if a cross happened and at the same time you saw potentially like a hammer candle here, or you saw an engulfing candle or something else, it's going to be very significant. So moving averages are great. They're a great tool, and you want to add them to your trend trading, but at the same time, you also want to put them with other things. You'll hear Tyron and I mention time and time again, create a business plan around your trading strategy. It's so important. And a lot of people don't do that. They'll only focus on using one thing. It's about creating as many reasons as possible to get in that trade.
Definitely. Now, one thing, we're getting a few questions here about analyzing the live markets and having a look at some pairs. This is more a teaching webinar, so we're actually teaching what we're doing. But for anybody who actually wants to look at the live market being analyzed in this fashion, we are actually running our own webinar straight after this one at 8:30, so literally 15 minutes after this one finishes. I'll pop the registration link straight into the chat window if you like. So for anybody who'd like to do a live market analysis with us after this webinar, feel free to join. I'll pop that in the chat window. You can just register for free there. And we look at all of the live markets. And so all of you who have put in requests for pairs, we'll be looking at most of those pairs that you've requested and doing our market analysis on those shortly.
Okay, so another thing that is often underutilized is Fibonacci retracements. It's something that many traders do use. Most people have heard of them. Some people don't know how to use them efficiently or effectively, but we can tell you that it is used heavily in the big market in terms of where people are trading large amounts of money from the banks down to some very large hedge fund traders. So Fibonacci retracements are really a great level of support or resistance for potential price retracements before it continues in its prior trend. The retracement ratios are generally 23.6, 38.2, 50, and 61.8. Tyron and I really prefer that kind of 38 to 50%. We'll explain that a little bit more soon, but really you want to think about everything logically when it comes to trading. If we have a pullback in the market, do we really want the market to come back too far? And the general answer is no. If you have 100 pip up movement, you don't really want the movement coming back more than, let's say, 50 pips, which would be the 50% fib of that move, because if it keeps coming down, what is that doing to the psychology of the people that are trading the market? Are they that confident that it's going to keep going up? And also, what happens on the smaller time frames? If we're trading a daily time frame and it comes back 50 pips on a 100 pip move in the direction of trend, what's happening on the 15-minute time frame, Ty? It's probably a change of trend to the downside, isn't it?
That's right. So you're right. You are losing a serious amount of market momentum and trend momentum if it does pull back too far. So yeah, look, a lot of people wait. Yeah, I've heard some stories where students are waiting for the basically a 76 pullback, and a 0.76 pullback
Oh, really?
or further. Like seriously, I mean, you might as well. It's nearly 100% pullback. You've got to remember that that's what the Fibonacci essentially is a percentage move of the initial move. So if the market has moved, say, 100 pips in the trend's direction, and it pulls back, say, 70 pips, that's a 70% retracement in effect. Okay, now yeah, does that seem like a strong, healthy trend that's going to continue long? Not likely, because it's going to have a lot more opposition to go long after that. It's pulled back quite significantly, which means a lot of the moving averages, a lot of the indicators have actually turned around on the smaller timeframes, like we just mentioned. So it's going to have quite a bit of work to do to actually get back up to even just make that high again, let alone break to new highs. So that's why in a perfect world, we would much rather it only pull back sort of that 38.2 to 50%, because that's a two steps forward, sort of one step back approach, which is what a healthy trend really does.
So that brings us on to optimizing your entry. So you really want to enter based on confirmation and not on gut feeling. That's one big one that a lot of people fail at. We've all been there where we think an hour candle or a daily candle is going to close a certain way. It may look like, let's say, a bullish hammer candle, and then we place the trade 5 minutes before, and then we're looking at it as it closes, and all of a sudden it does not look like the bullish hammer anymore, and it looks more like a bearish kind of candle. So do not ever place a trade without some form of confirmation. You can't use your gut feeling. Unfortunately, if you're doing that, you've just got to be honest with yourself and say, well, what's going to happen over the long term when I try to scale my business, when I try to trade larger contracts, when I try to put larger money in the market? Will I be that confident in my gut feeling over the long-term period of trading? It's very difficult. You might get it right 2-3 times, but Ty, I tell you what, you don't want to be doing it forever.
In our experience, if you're going to go on gut feelings, you're going to have a lot of gut aches. That's what it's going to give you, because you will come undone, and you haven't built a foundation on really a solid strategy. Like if somebody asked you what's your strategy, and you say I go on gut instinct, that's not really going to resonate with anybody else, because at the end of the day, it might work for you for a little while, but you're never going to be able to really grow your account and grow your trade size with any form of confidence, because gut feeling is not something you can really backtest. Okay, numbers are really what you need to see. You need to see a solid strategy that is repeatable. The one thing about a gut instinct is it's not a repeatable process that you can actually backtest and prove its worth. You need to be able to quantify decisions that you make, so when you do see them and they play out the same way, because that's really what technical analysis is. At the end of the day, it's really just history repeating itself. you need to be able to really lock that down and say, okay, this is why. This is going to work out 7 or 8 times out of 10, and I'm going to place the exact same trade every single time. Gut instinct just does not let you do that.
So how do we get around using gut instinct? Well, role reversal is definitely very solid in terms of following trends. So role reversal, we talk about it again regularly on the webinars because it's just so important. It's where maybe resistance, which was previous in the market, we've seen a uptrend here, and we can see the market's breaking through. The market comes down and it tests that previous level of resistance, and that acts as support. So if we're having a look in the market at how it may look, here we go. We've got multiple tests of this 132.77 zone, and then it breaks through, the market comes back down, tests that area, and that area acts as support. And when that happens, very, very significant is this level here, because this is the zone where the bigger players, the bigger market makers are going to be buying it. So often you'll see a break happen. This break will happen, let's say, out of a news event. You can see that the market was accelerating incredibly quickly coming up to this break and then break straight through. So that may have been a news event that made this happen. Then it needs a bit of a breather. Let's reset the indicators. What's actually happening here is that all of the shorter term indicators and things like stochastic and things like all the oscillators and things like that may be resetting back from overbought to become oversold. So that's why you see this consolidation. It comes back, tests this level. You might see a really nice candle here, like again, if you see a bullish hammer here or an engulfing candle would be excellent. And this is a high probability kind of zone. So that's what you want to be looking at when it comes to role reversal, when it comes to following trend trades. And what also, if this was a Fibonacci retracement zone, what if this was a 38.2 Fib pullback at the same point where the resistance becomes support? It adds to our trade. So the big traders, they definitely do this. This is also how they add to their orders. So they might have buys down here, they might have reloaded potentially here, and then they'll be adding to their positions because they've seen the confirmation break. That allows them to put more risk on. And then that's also how they take risk off, but that's for another webinar. The real importance of tonight is to learn role reversal.
That's right. And look, you can bet your bottom dollar that if a Fibonacci retracement was drawn on that move up, that first supply zone would be a 38.2 Fib retracement. No question about that. And actually, for the fellow who actually asked a question earlier about supply and demand zones, role reversals are another really good example of supply and demand zones as well. So a lot of transactions happen around these levels because that is, and they are generally good Fib levels as well. So you can definitely put that down as part of that answer, that role reversals will work as very, very good supply and demand zones, as well as good Fibonacci retracement zones.
So step 4, and another thing we want to do is we want to look at some great market conditions. So one thing that often happens is trend will often start off with volatile news announcements. So what are some volatile news announcements? Well, some examples of that would be probably what we're going to see in next coming months, which will be a full Brexit announcement. We've obviously seen the US election. Now, for anyone that did trade that, many of you wouldn't have, but for guys that did see the live markets that day, I do remember the indices, Ty, absolutely getting smashed during that day that Trump got elected. And then by the end of the next morning, so the end of close in the US stock exchange, the index had actually recovered and it was higher than it was previously. So it was something like a 6 or 5% movement backwards and forwards during that day. Very, very significant. And then the trend from that point on was actually bullish. So that was the beginning of a fairly large trend on things like the US dollar yen as well. That was a very large trend that happened there. So we want to know the most important bits of news. Generally speaking, elections are really important. Non-farm payrolls in the US, which happens the first Friday of every month, incredibly important. And these often break resistance support levels. We also see things like interest rate decisions and Reserve Bank statements from the currency that you're trading will be incredibly significant. So there's no coincidence that when you're looking, let's say, at a channel pattern, often at the point of resistance or the point of support, the market will literally be sitting there just before the news announcement because it's getting ready for that news announcement. And that's why it's so great to trade technicals, because if it breaks, well, you know the news announcement was potentially positive for that particular currency. And if it goes down and under, then of course it was negative, but you didn't even need to know what the fundamental result was. The technicals have told you what's happened. So you want to really practice that discipline, waiting for confirmation when looking for trend trades. Darren, do you have anything else to say about that one?
No, look, that's it's vitally important. Yeah, look, trend is your friend. Everybody knows it. Everybody says it. Yeah, when you identify a good one, you're going to get multiple opportunities to trade in the trend's direction. And this is another reason, like, why you don't really have to go to 50 or 60 different pairs, because you only need one or two really good solid trends to be able to break down the smaller time frames and have multiple opportunities inside each of them. So yeah, vitally important to be able to identify that. And for anybody who is stuck on, learning which way a trend is going, if you're at that level where you don't really understand trends, you can go back through the Pepperstone webinars that we've done previously on the YouTube channel. And I know that we've done a couple of webinars on how to identify trend and the best way to find it and trade with it. So just go through your Pepperstone YouTube channel and you'll be able to watch some of those webinars that we've done on it, because we go into heavy detail on how we actually join a trend, and also most importantly how to identify one.
So I thought we'd go through a couple of tips and tricks or some things that I guess are unfortunately clear when it comes to trading, and that is that a lot of news is mostly noise. So you'll notice that when you look at economic calendars and you see, let's say, the CPI result, that CPI result might initially move the market, let's say 20, 30 pips, but then by the next hour, it's back to exactly where it was. And that's because a lot of this news really doesn't move these large currencies that much. The other thing that comes from that is that unfortunately, when it comes to trading trend and being disciplined and having a business plan and everything like that for it, trading done properly can sometimes be boring, guys. It's unfortunate, but it is true. We often see people saying, oh, I haven't done any trades today, and they feel like they wasted time. The best thing that you can do is that you set alerts in the market, either email alerts or mobile alerts for your key zones. And if those zones aren't hitting, you don't necessarily need to be looking at the market because you're not getting those alerts. So it's true, trading can sometimes be boring, but when the trend is on and when you're seeing breaks of channels and it's happening for those 5-6 months of the year, it's very exciting. So it can be boring, but it can be exciting, just like any job out there. I've got a few people just asking as well where the YouTube channel is, and it's just just search Pepperstone in YouTube and you'll be able to find the YouTube channel and watch all of our webinars in there as well. So you must also plan the trade and trade the plan. So that means that you need to be thinking a few steps ahead when it comes to trading any kind of pattern or any kind of trend. Always look for potential opportunities and then highlight those and come back and set alerts for those things. So it's like chess. You want to be thinking quite a few steps ahead, and then of course you want to be trading the plan that you had and the plan that you made before it. Most guys out there, we all do this as well. Unfortunately, everybody seems to have this trick of getting into a trade. All of your good plans go out the door, and then you end up watching it on the 1 minute, 5 minute, 15-minute chart, which is really unhealthy, and then maybe take your profit too early and let your stop losses run too much. So we've all been there. Many people have been trading, have done this mistake. It's only human nature. Unfortunately, the big guys do know this, and they can potentially take advantage of that kind of stuff. So make sure you trade your plan.
Actually,
I sound like a preacher there, Ty, but it's true.
I know, it's true. I know. Look, I know a lot of people who come to our regular webinars have actually, well, they know what we're about. So, but what I will do for all of the people who haven't done our Pressy account building course, it's a free course. I'll pop the login for that in the chat window also, because that'll, yeah, anybody who hasn't done it, yeah, jump on this and do this course. It's free. It'll give you a very, very good insight on what those last couple of points were actually. And yeah, the link is there on the screen, but it's also in the chat window for you, for anybody who wants to register for it. It gives you, it really forces you into talking, basically placing the instruction that we have done here for every trade that you place. It's really, really important that you focus on a strategy that involves, well, it is really a checklist to make sure that you cover every base every single time, because that's the only way that you will become a professional trader. And it means that, look, there are going to be times where you are going to analyze the markets for hours on end, and there is literally going to be nothing to trade. But choosing not to trade because the market isn't setting up correctly is a trading strategy in itself. Make no mistake. So, you know, really, it keeps you out of bad trades as much as it gets you in good ones when you do the correct analysis. So it's really, really important. So, yeah, anyone who hasn't done it, jump on and do it, because it's a very valuable, there's a lot of very valuable lessons in there.
Okay, well, I think we'll hand it over to a bit of Q&A. I think that is a lot of information, but also there's some really good tips for everybody out there to use, and hopefully you got something out of tonight's webinar. Do we have any questions in the chat? If you do have a question, please ask it now. I know Tyrone and myself have answered quite a few of them, but if anyone else has a question, please ask it right now, and we'll see if we can get to that.
And we are running a lot of for the people who have asked, we are, again, like I'm getting a few requests to check trades. We will be doing that in the next webinar, which is starting in 15 minutes. So for anybody who'd like to come to that webinar, yeah, feel free to click on the link in the chat window. It's posted in the chat window. Just click on that registration link, and that one starts in 15 minutes. We will be applying a lot of the learning that we talked about tonight in that, because if it appears in the live markets, we really love to actually analyze the live markets with these techniques. So that's what that one's all about. So for anybody who would like to come to that, yeah, just jump in and yeah, you can join us in 15 minutes. How much does it cost to buy Pressy is the question we've got here. Okay, Pressy is our proprietary trade planning system. It's actually part of our foundations and advanced course. So all you have to do is the advanced and foundations course, and basically you will get Pressy for free, and that comes with it. So because it is actually part of the whole process. So I will, if you like, I'll send you. I'll give you an email to send your email to, and I'll send you some more information on that one.
Okay, all right. Well, I think most of the questions we've kind of answered here. Hopefully everybody enjoyed tonight. And if you have any other kind of ideas or things that you'd like to see in the webinars, we always appreciate your feedback. So please do give us your feedback to Pepperstone, and we'll try to get around to some of those topics and some of those things over the next coming weeks. So I think for now, we'll see everybody in 2 weeks. We do have some exciting stuff to go over. I'm pretty sure we're going to be looking at some CFDs as well, Ty, which is going to be really, really exciting, and we'll focus on that.
Yeah. We are going to delve into some indices and start looking at some of the CFDs that we've got on the platform. So very exciting stuff coming from Pepperstone in the next few weeks. So
and reporting season as well. So.
All right, guys, thank you very much for joining us. I hope you've learned. If you've got some valuable things, if you've got any questions, feel free to email your Pepperstone account manager. Yeah, we'll be able to touch base with you separately if you have any questions on what we've talked about tonight. And go through those Pepperstone webinars that we've done in the past on YouTube if you want to learn about trends like we talked about earlier, because there is some very valuable information and it makes a very, very big difference to how you place your trades. So other than that, we will see you all hopefully in 2 weeks for the next Pepperstone webinar. Have a good night, guys.
See everybody.